The truth of stock investing, why research is essential before big earnings. At around 11:30 at night, a young investor was looking at a chart on his phone. The stock was running upwards, everyone on social media was writing its name. Without reading the annual report, without understanding the business, he pressed the buy button just by seeing a viral post. The next day the market opened, and his excitement slowly changed into fear. The stock was falling down, people in the group had disappeared, and the very tip that had made him confident was now looking like his biggest mistake. The fear begins right here. Does the stock market truly create wealth, or can it weaken hard-earned money in minutes without research? The curiosity is how in that same market, where someone loses money in panic, some investors stay calm and make long-term wealth. The boom in market participation. The craze for stock investing has grown rapidly in India. From small towns to metros, a demat account is no longer a thing of only big investors. According to NSE data, in 2026, the registered investor base had crossed the mark of 13 crore unique investors. This shows that market participation has now reached a mass level. But as fast as people are coming into the market, risk is also increasing just as rapidly. Because opening an account is easy, but choosing the right stock is not easy. Today you can buy a stock in one click on an app. But understanding a business requires patience, reading, and discipline, which every investor does not develop. In the stock market, money is made from business ownership. Buying a share is not just buying a price, it is buying a small ownership in the company's future profit. If the company is strong, management is honest, debt is manageable and growth is real, then time can become the investor's friend. But if the business is weak, profit is artificial, debt is hidden, or valuation is very expensive, then that same stock can become a trap. Core pillars of fundamental research. The first step of research is understanding what the company does. If you do not understand the business model, then investing just by seeing price movement is risky. Whether the company sells a product, provides a service, does lending, makes software, runs infrastructure, or depends on a commodity, knowing this is necessary. The second step is where the revenue comes from. If revenue depends on a single customer, a single product, or a single geography, then the risk will be different. The third step is profit quality. Just an increase in net profit is not enough. It will have to be seen whether the cash flow is also moving along, or if only accounting profit is visible. Many companies show profit but cash does not come. In such a case, receivables increase, and the investor has to understand whether the money is on paper or in the bank. Debt is also very important. A company with low debt can survive in a downturn, but a company with high debt can get stuck in an interest burden. Debt is not always bad. But if growth is not being created from debt and cash flow is weak, then the risk increases. Management quality is the heart of research. The promoter's track record, related party transactions, pledged shares and shareholder communication tell a lot. If the promoter is pledging shares again and some governance questions are arising, or the auditor is resigning, then the investor should stop and think. The annual report might look boring, but this very thing tells the real story of the company. The chairman's message, management discussion, risk factors and notes to accounts should be read carefully. Quarterly results are not just a headline. Sales growth, margin, profit, debt, order book and management commentary should be seen together. A good company does not become bad just because one quarter comes out poor. But continuously weak numbers can be warning signals. Understanding sectors and valuations. In stock investing, understanding the industry is also necessary. A good company can face pressure even in a bad industry cycle. Banking, IT, pharma, auto, cement, FMCG, chemicals and real estate. Every sector has a different cycle, regulation and risk. If an investor does not understand the sector cycle, they can make the mistake of buying at the peak and selling at the bottom. Valuation is the most difficult but necessary part of research. Even a good company can give poor returns if bought at a very expensive price. Metrics like PE ratio, PB ratio, EV/EBITDA, ROE, ROCE, and free cash flow yield help, but they should not be seen alone. The valuation of a bank cannot be compared with a manufacturing company. Every sector's business model is different, therefore the context of the metric is necessary. Research does not mean that every investor should become an analyst. It means doing minimum homework, leaving blind faith behind. If you cannot do direct stock research, then the mutual fund route can be better. Because in direct stocks, the responsibility is entirely yours. The perils of FOMO and F&O trading. The most dangerous line in the market is, everyone is buying, The crowd is sometimes right, but often it is late too. FOMO forces an investor to buy expensive. When a stock is hot in the news, many times smart money has already booked profit before that. SEBI has given a serious warning regarding retail losses in its studies on equity derivatives. Between 2022 and 2024, 93% of individual F&O traders saw a loss. In 2025 too, the risk picture of derivatives trading remained weak, and according to reports, the majority of individual traders remained in loss. This shows that the path of quick money can be very dangerous. There is a world of difference between stock investing and F&O trading. Investing is ownership, trading is a probability game, and leverage makes the loss faster. If you are a beginner, first understand the cash market, diversification, and long-term investing. Jumping straight into options trading is like entering deep water without learning how to swim. Technical analysis can also play a role in research. Charts show support, resistance, volume, and trend, but these cannot take the place of business quality. Technical analysis can help in entry-exit, but for long-term wealth, an understanding of fundamentals gives a stronger base. A stock is not good just because its chart is going up, and it is not bad just because it is falling in the short term. Market price changes every day, but business value changes slowly. An investor has to learn to differentiate between noise and signal. Reliable tools and resources. For reliable information, NSE, BSE, company exchange filings, annual reports, and official investor presentations should be looked at first. Corporate announcements, financial results, shareholding patterns, and price volume data are available on the NSE and BSE websites. This is a much more trustworthy source than WhatsApp tips. Platforms like Screener can help in understanding financial ratios and historical data. But before taking a final decision, cross-checking original filings is necessary. TradingView can be useful in chart analysis. But by looking at a chart, a company's governance, debt, and cash flow cannot be understood. Educational resources like 𝐟𝐸𝐺𝐵 help beginners in understanding market basics. Learning is the most underrated investment in investing. Money Control, ET Markets, and financial news platforms give updates, but make news the starting point of research, not the decision. The finfluencer culture has grown a lot on social media. Some creators give genuine education, but many people can also be involved in hype, paid promotion, and pump and dump. SEBI has cautioned investors regarding social media stock scams, especially asking them to be careful of WhatsApp, Telegram, and fake exclusive access claims. If anyone tells of guaranteed returns, a sure shot multi-bagger, or inside news, then understand that the risk is very big. A claim of a guarantee in the market is often a danger signal. Effective portfolio risk management. A part of research is risk management too. Putting too much money into one stock in a portfolio can be dangerous. Diversification does not mean buying every stock. It means keeping a balanced exposure in different quality businesses. Position sizing is very important. If one wrong decision breaks your entire capital, then the strategy is weak. A stop loss can be necessary for traders, but a thesis review is necessary for investors. If the business reason is broken, then holding on to it out of ego can increase the loss. Long-term investing does not always mean holding. Long-term means keeping patience, as long as the business quality and valuation thesis remain valid. Many investors get scared as soon as the price falls, but a fall is not always a risk. Risk happens when the business is deteriorating and the investor is ignoring it. A market correction can be an opportunity for wealth creators if they have made a watch list and valuation discipline beforehand. Research gives conviction to the investor. Conviction not because the stock will never fall, but because in a fall the decision will be made from facts, not from panic. A good investor writes before every buy, "Why am I buying this stock?" This small note gives very big clarity in the future. If the stock falls, that same note tells whether you have to average, hold, or accept the mistake and exit. Making a mistake is normal in investing. It becomes dangerous when the investor does not accept the mistake and keeps holding on to the loss because of ego. Profit booking is also a part of the strategy. If the valuation becomes very stretched or a better opportunity is found, a partial exit can be wise. Do not ignore tax either. Short-term and long-term capital gains rules can affect your net return. Brokerage charges, STT, and taxes can silently reduce the returns of those who trade frequently. Research saves the investor from overtrading. When you think like a business owner, you do not give a reaction to every daily candle. The most powerful investors often speak less and read more. They do not search for tips, they search for clues in annual reports, con calls, and numbers. If time is short, a monthly SIP in index funds or mutual funds can also be a practical route. It is not necessary for everyone to become a direct stock picker. But if a fat sum is to be earned from direct stocks, research is not optional. This is the foundation of saving capital and identifying an opportunity. Remember, the stock market can become a place to transfer money from impatient people to patient people if an impatient investor takes entry without homework. Cultivating a long-term mindset. The story of that young investor who bought a stock on a viral tip does not end here. After the loss, he opened an annual report for the first time. He understood that the most expensive course in the market was not any paid course. The most expensive course was his own mistake. Now, before every stock, he understands the business, reads numbers, looks at valuation, and uses social media noise only to check signals. Earning a fat sum in stock investing is possible, but not through a shortcut. It is through correct research, discipline, patience, and risk control. If you are new to the market, make a rule today itself. Before pressing the buy button, understand the company so much that you can tell a friend in clear language. Because money in the stock market does not reward only those people who come early. It rewards those people who stay after understanding. And this is the real difference between a tip-following trader and a serious investor. One runs in noise, the other makes a decision from research.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.